Share the screen. So we're going to talk about this beautiful concept of basics of the tax planning. So first thing that we need to know is to understand what is the tax plan. Tax planning technically means that we try to minimize the tax that the person is going to pay. Sometimes this tax planning is short term. It means that we will reduce the payments of the person just for this year, but it will go to the future years. Sometimes it's like a long-term tax. You remember we talked about the difference between cash flow and income. Yeah, what was the difference between cash flow and income? Any thought? Difference between cash flow and income. Cash flow does not get reported in the tax return, so you don't need to pay tax on it. But income is taxable, and we have to pay tax on it. You remember when we talked about the difference between the RRSP and TFSA? We discussed about the difference between cash flow and the income. So most of the times when you are planning for a person for a long-term tax plan, not a short-term tax plan. So you should understand the difference between these two and mostly focus on what? On generating cash flow for the person in the future. Stable cash flow in the future. For example, when you want to plan the retirement of a person, so you should consider that the person should have a tax deduction now, and in the future, down the road, when they get retired, they should pay less tax. So let me just give you an example. Let's say that you make $100,000 and you have to pay $25,000 tax. But and another scenario is that you make $60,000 and you have to pay $20,000 tax. Which one hurts more? Yeah, what do you think? $100,000, $25,000 tax? $60,000, $20,000 tax. Definitely the second one hurts more, yeah? It's more painful because it's a bigger chunk and your income is low. So it's exactly what's happened in the retirement for people. Whenever you're planning the tax for a person, you should consider that how this person is gonna retire. It's very important. When the person is retired and they have to pay $20,000 tax, it stings more, it hurts more compared to paying tax $25,000 tax now. So I'm saying that one because a lot of people, when it comes to the tax planning, a lot of uneducated people, when it comes to the tax planning, they're all looking for instant tax refund for a person. Through what? Through some accounts like RRSP. We discussed about the accounts in the previous session. You remember the RRSP account? The RRSP was the one that the money that you put in was deductible, but the money that goes out was 100% taxable. You have to pay taxes. So when it goes in, the person is at $100,000 tax income. When it comes out, the person is at $60,000 income. So the tax that they have to pay here is more than the tax that they have. And so I'm not saying that you should not use the RRSP, but you should always keep a balance that especially when you're planning for long term, at the retirement, between 60 to 80% of the money that the person gets should be cash flow. Should be exactly dollar by dollar, exactly goes to their pocket. And something between 20 to 40% should be taxable. And when the person has a higher income, for example, I have a plan for a client of mine that is going to have in 5 years, he's going to have an income about $25,000 a month. So with that income, it's very important to have, more cash flow compared to a person that has, the plan is to have $10,000, $8,000, $7,000 a month. So for that person, it's better to have more income because it doesn't jump into high tax brackets. Does that make sense? Yeah, is it clear? So first of all, to understand the difference between these two and use the accounts. You remember we all talked about that. We have advisors at 3 levels. What was the levels? Yeah, what are the levels? Level 0 is those who can just provide products. They are licensed, they can provide products. The level 1 is those who can provide plan. And the level 2 is those who can have strategies. So when you want to give advice to people, definitely you're going to start from here. And you should not just listen to the client that the client wants, just to say, get more refund now, I would use the RRSP. You should be able to educate the person and explain why you're suggesting the RRSP and the TFSA to have both for the retirement. Because down the road, when they get to the age of retirement, that money will hurt more to them. Okay, does that make sense? Then, when we talk about tax planning, majorly we have a couple of strategies. The first one is called tax transfer. What does that mean? Or another name for that one is income splitting. So let's say you remember the tax system that we explained about it, the brackets and everything that we talked about it. So a person is at 40% tax. And this is the lady. The other one, for example, the other spouse is at 20% tax. So when we talk about splitting, let's say that we can deduct a part of income from here and put it here. Because of this tax difference, we're going to be able to save 20%, yeah, on the taxes. So in some countries, like the US, you can do that one. When the couple they are married, they can transfer the income from one bucket to the other's bucket. But in Canada, in general, income splitting is not allowed. But there are some options for income splitting. Like if you have a pension income, you can split that one. What does that mean? Let's say that this spouse is at age 65 and is still working and making a good money. And the other one is at age 62, does not work that much, makes it lower amount of money. So she's at age 65, has to start taking out money. So if she adds any money to this bucket, she has to pay at least 40% tax here. So for the pension, if it's a pension income, so the pension can be transferred from this bucket to this bucket. Now they're paying how much tax? 20%. Yeah? So technically we are saving 20% tax. Pension is one of those things that you can do that one. The other one is the RRSP that it's called the spousal RRSP. one spouse put the money into the RRSP, gets the deduction. The other one takes out the money and pays the tax. So let's say this one got the deduction at 40%. This one got the money and take the money out and pay tax at 20%. But for this one, you need to know that there is 3 years gap. There should be 3 years gap. What does that mean? It means that, let's say that she has contributed in the account in 2020. If the other one takes the money sooner than 2023, if they take out the money after 2023, that money will be added to this bucket. If they take out the money at this part, the money will be added to this bucket. You see the difference? Does that make sense? Unmute yourself. No, I don't like to be just a single talking person. So participate in the discussion. So this splitting is a great tool that you can use. And whenever you are planning for people, for example, you're planning for a couple, one of them is at very high level of income, and he or she has a great pension plan from the company, a private pension plan. And you know that at the retirement, this person will have much higher income. And he has a lot of investments, rental properties, everything. You know that this guy is going to get a lot of money. So it's good to start using. You remember the deduction limit for the RRSP? We talked about it. It's 18% of the income. So start using the spousal RRSP. It means that this one who has a better pension plan, has a better income, will contribute to the RRSP and gets the deduction. So saved on taxes more. And then this one that has a lower income will take out the money and pays the tax down the road at the very lower tax return. Yeah? Does that make sense?
Yes, sir.
You look a lot confused. I can read it in your faces. Just unmute yourself, participate in the discussion. Because when you stay silent, I can't read it from your eyes that you do not understand. Okay, so we have a couple. Okay, this one's income is $200,000. This one income is $40,000. And this guy has 2 rental properties, has a lot of investment accounts, a lot of things. And now his MTR, you remember what was the MTR? Marginal tax rate.
Tax return. Tax rate.
Marginal tax rate was the highest bracket that the person was in. Get? So the MTR for this one, let's say that is 50%. For the other one, this one is do not have that much of investment, not that much of rental properties, not that one. And the MTR for this person is going to be, 20%. So if this person puts the money in a spousal RRSP. So if this person put the money into the spousal RRSP, he's going to get deduction. Let's say that he put I don't know, $20,000 each year. Okay. So he can get a deduction for 50% of this. It means that $10,000, 50%, $10,000 tax saving. Is it good? Then we assume that the money is not growing. It stays the same. Now, after 3 years from the last contribution, let's say that this person has done it for 10 years. So after 3 years from the last contribution, the other spouse starts taking out the money. Now they have to pay tax. How much is the tax that they should pay? Let's say they take out $20,000 and the money has not grown, nothing, $20,000. So they have to pay 20% tax. It means that they have to pay $4,000 tax each year. So how much tax did they save? $10,000.
10,000.
How much did they pay?
4,000 over there.
$4,000. The sum is $6,000 tax saving.
Saving.
Did you get the point? How it works? Spousal
Yes.
RRSP is a great tool when it comes to the couples. Especially, it happens that the lady is working, the guy is taking care of the kids, stay at work at home, or the other side. And so the one that stays at home, take care of the kids, has lower income. So the money that is transferred from this one to the other one will help them a lot. I have a client, the guy was a lawyer with $600,000 income. And the lady was a housewife with almost no income. So we put $30,000 in a spousal RRSP. So they got $15,000, more than $16,000 refund from the CRA. Then the lady, 3 years later, she will take that one out. And for that $30,000, she almost is not going to pay any tax. Because she claims all the childcare expenses, she claims all the medical expenses, everything will be claimed by her. So the basic amount is there for $15,000 is tax-free. And then all the childcare expenses and everything will get deducted from that one. So then she's not going to pay any tax. So in general, what's happened, they have saved about $16,000 in taxes each year. Does that make sense? So it's a great strategy that Canada allows us to do that. I'm not going to dive into all the details of the income splitting. And it has a lot of more complicated strategies that I'm not going to explain it. Maybe we can talk about it later, but it's good to know that one. So the other one. Now, it's clear, it says that change the nature of the income. So what does that mean? Let me give you an example. I want you to participate, please. When you do not participate, get me bored. Participate in the discussion. So let's say that we have a person who is a plumber. On average, plumbers make $250,000 as the business income. If, let's say that the brackets are here, if she pays the tax individually, so he's gonna pay how much? He's gonna pay about $80,000 tax. So he's gonna get how much? $170,000 money after tax. So what is the nature of this income? It's business income. Yeah?
Yes.
You remember that we did talk about it. Business income is 100% taxable. Now, what if we change the nature of this income to another income? So how? We change the whole strategy. This business income goes into a corporation. So now $250,000 is in the corporation. And the person has to pay $25,000 tax. corporate tax. So $225,000 is left. Now, we have the brackets here, yeah? And let's say from this number, the person to that $150,000, the person almost needs how much of that one? The person needs about, no, let's say 100,000 of that. So instead of paying the tax on the whole $250,000, now he takes out 120,000. As what? As dividend. You remember that dividends, they have credits and they have lower amount. We need to pay lower tax on them. So now for this $20,000, the part that's going to be taxable and everything, the person has to pay almost $20,000 tax. It has how much? $100,000 for the lifestyle. Now, how much is remaining there? 120 is out. So the remainder is $105,000 is still remaining in the corporation. In what account? Those who are accountants know that one. Retained earnings. Yeah. And then from this retained earnings, we can use it as the future retirement money for that person. And you know, in your next level, I will explain it to you how you can take out this retained earning from the corporation without even paying the personal tax. And we can just discuss that one in the, hopefully you all passed the level 1. In the level 2 and 3, we're going to discuss it. So did you understand that one? This is one strategy.
Yes, Professor.
How does that sound? Good, yeah.
Good.
Now, I have another strategy. It was the strategy 1. Now, for the second one, let me use another copy. So, the person does the same thing. Put the money into the corporation. But at this time, for $250,000, he takes out and put, no, let's say $200,000 of that one in the corporation. So 200 of this one went to the corporation, $50,000 here. He pays maybe $8,000 tax. And then how much is this?
42,000.
$42,000. How much did he need? $100,000, yeah? Now, the person, for this $200,000, he has to pay $20,000 tax here again. So how much is left? $180,000. From that $180,000, he takes out another $80,000. So as dividend, so another $80,000, and then after tax and everything, let's say that $60,000 remain here. And the person will have that $100,000. Now, how much is left here? 100K in the retainer. Now, the person, after a couple of years, he sells the share of the corporation because he personally owns the corporation. Yeah. He sells the shares of the corporation, and let's say for 10 years, they have accumulated how much money in that one? Each year, $100,000. For 10 years, he has accumulated $1 million. Does that make sense? So from that $1 million, what will happen? He has to pay, instead of paying tax on the dividend, he sells the corporation. Now, another person B comes in, and he sells the shares to that person. For that much, for $1 million. And he's no longer shareholder. And the interesting part is that that $1 million is 100% tax free. Because there is something that's called lifetime capital gain exemption. I'm not going to dive into all the details of that one. Then in your next levels, when we get to the concept of the corporate tax, I will explain there. So now the person even does not need to pay the tax on the retained earnings. You can literally sell the retained earning for what? By selling the shares of the corporation. There are another strategies. I'm just showing you that you have a lot of tools on your toolbox. And picking any of these strategies is based on what? Based on the needs of the client, the knowledge that you were able to transfer to the client. So you see here, the main thing that it will help you success is how well you have educated your clients. And you have educated yourself first, and then you have educated your clients. There are several different ways. I explained 2 ways of it for you. I can just remember 3 more ways that I will explain it later, but you have a lot of tools available. Pick the right tool like a professional. Okay. How does that sound? Are we good? Is it clear?
Yes, sir.
Yes.
Okay, good. So technically in this one, in the second scenario, we are converting the business income to capital gain. And in the first one, we are converting the business income into dividend. So when you change the nature of the income, what will happen? It will change the tax behavior for that income. The other tax planning strategy that is here is what? Is tax deferred. Like that one. Tax deferral, something like that. I think I should go get an ESL course. Yeah, I don't know I'm not sure about it. So what does that mean? Tax deferral, it means that I do not pay tax today. I will pay the tax somewhere in the future. What does that mean? You remember the idea of the RRSP? In the RRSP, we deduct today, pay the tax in the future. It's exactly the idea of tax deferral. Or in the corporate idea, we pay the corporate tax today, postpone the personal tax in the future. That you have lower income, we take out the money from the corporation, pay lower tax. And in other sessions, I will touch base on that concept, that how to defer all the taxes all the way to the death. And then, get some strategies how to pay the taxes at that time. I'll explain them later. So the tax deferral is something that is important. Another solution for the tax. So are we good so far?
Yes, sir.
Okay, wonderful. The other strategy that you can do that one. Yeah, I would just not forget about that one here. In Canada, there is something that is called tax on split income, or TOSI. This TOSI, it's just very serious. If the Canada finds that you are splitting your income through some not allowed ways, like what? Like giving shares to the children in the corporation that they are not active, or paying your spouse an extra amount of salary from the corporation, stuff like that, they will charge a highest tax bracket, which is 53% on that income on the personal side. So if you heard about this one, it's very tricky. And whenever you want to use this income splitting strategies, always check the last version of the TOSI and make sure that it's not happening. Because I have a client, he owns a pharmacy, and he pays his child for $20,000 a year for drug delivery. It's just giving the medicines to them. And they said that he uses a scooter to deliver the medicines to them. But that it was not what he was doing, and he was not able. The kid was not able to do that one, and the CRA audited them, and then they said that that income is on TOSI. So technically, on that $20,000, the kid didn't need to pay any tax, but CRA took 53% tax on that. Plus the penalties, it was almost $13,000 tax on $20,000. So, TOSI is something very serious. Whenever you're thinking about, splitting income, always consider the rules of this one. And then, the other thing is being aware of the credits and deductions. You remember what we talked about, the difference between the credit and deduction? What was this one? What was the difference between credit and deduction? Any idea? Credit is the amount that you can deduct from your tax. Deduction is something that you can deduct from your taxable income. It reduces your tax, this reduces your taxable income. So usually for the credits, we have 15%, but some for dividend credits, stuff like that, we have higher credits as well. Or there are some credits that are very amazing. If you have some clients, you come across with people who are philanthropic, they want to do charities and stuff like that. So donations has a huge credit. Do not forget about the donations credits. It will give them a lot of success. Political contributions, paying to the political parties, it will give them a tax deduction, a tax credit. And this is a huge one. Technically, whatever the parties spend on election is from our taxes. At least 30% of that one is from our taxes. Because people who pays their campaigns, they get the credit for 30% of that. It means that they pay 30% tax less. In the other word, 30% of the money that they spend on their campaigns come from our taxes. So it's very important to understand the credits and the deductions that are available. The other thing that is important, this is the other one, I have explained the deductions and credits, deferral splitting, tax efficiency investments. I talked about the RRSP, RRSP, and corporation business structure. We talked about it. So I almost covered all these topics at this level. Definitely, we want to go to the details. We're going to jump into a lot of rabbit holes. We're not going to get out of it. So we're going to skip it here. I'm not going to dive into a lot of details of that one. The other thing that is some mistakes that usually people do, they do not use the available tax credits and deduction. Why? Because they don't know. You remember in the 2 sessions ago, I explained that, BC renters credit that pays people $400. So a lot of people, they didn't use that one. And when CRA reviews your tax return, they usually do not reduce the amount of tax or increase the amount of refund that you're going to get. So they won't say that, oh, this person has not claimed the renter. They assume that you didn't have that credit. You were not eligible for that credit. That's why you didn't claim it. So they're not going to let you know. If you know the system, you will take advantage of it. If you don't know what's happened, system will take advantage of it. For tax system, it's very true. The other one is poor record keeping. You know, a lot of times, especially when you use tax planning and tax strategies, like the corporation, all those things that I explained to you, CRM may audit you, and they will come after you to send them the document. So it's very important that you keep the documents properly, especially when, for example, the person has a business income and they do not keep the documents for the expenses. So they ask for the detail of the expenses and the supporting documents. They don't have anything, they just ignore that one and they increase the tax. So it's very important to be aware of the process after the tax filing and be ready for that one, because anytime you may get reviewed and then you need to provide them with the document. So keeping the document is very important. And ignoring the, investment options like the TFSA, RRSP, these stuff that we talked about in the previous session is crucial as well. If the person ignores that one, you have to pay higher taxes. And the CRA will never get back to you that why you didn't contribute into your RRSP. You could save, 50% on taxes if you have contributed that one. They would never do that one. And you should always have an eye on the person and on the people's situation. And there is a term that it's very important whenever you want to file your own tax return or the other's tax return. And this is called the KYC. You know what that stands for? Know your client. It's very important because most of the time, people are not aware of the credits and everything that is available. You know, but you don't know which one applies to them. So the first thing is to ask them questions. That if do you have a child? Yes. Have you ever paid for the daycare, for any medical expenses, anything that is related to the child? Okay, yeah. So this is the maximum that you can deduct, and I think it's $12,000 for the kids. Zora, you can you know that you can deduct up to $12,000 the daycare, all those expenses from your taxes. It's a credit. So you should be able to ask proper questions. If you search, you can see the questionnaire for the KYC for the tax return. And if you get your license, you become an advisor, then there is a separate process that you need to do. So I have another appointment, so let's keep it here. And in the next session, we're going to talk about another topic. So let me stop it here.